So what we continue to see, Simon, is a divergence between what we call the real economy and asset markets, right? In other words, the asset market, the S&P 500 is the main one, for instance, has continued on what we call a V-shaped recovery thus far, whereas the underlying economy is more grinding out a recovery, which is much more muted, right? Now, the overlaying that, what we are looking at is the continued support on the fiscal policy side. That is, governments are, injecting additional resources into the economy. The US has recently passed its additional fiscal stimulus under the new Biden administration, and there continues to be a raft of fiscal measures within the European and advanced economies. On the monetary policy side, we're still seeing continued support because, you can think of the economy as still on the mend. It still needs, that kind of support and hand-holding from the policymakers until it can walk by its own.
I suspect that the distribution of the vaccine would also chart global growth as well.
Yes, man, definitely. So that overarching theme of the corona-shaped recovery is still pretty much in play. To the extent that all the bottlenecks are cleared out in terms of the supply chain, getting the vaccines out in the advanced economies, that will definitely allow some of the beaten down sectors to come back on stream. So we're talking about the entertainment, we're talking about travel and tourism, which is the world's largest industry.
Okay, I understand. And now, from a fiscal perspective, we've seen where, all right, so the way the macroeconomy is stated now, or the way it is now, the global economy, rates are very low, right? Yields are very low. Central banks have been doing more accommodative monetary policy to support economies. How has the fiscal side, how have they been performing on the fiscal side?
So the fiscal side has really been basically helping the monetary side, right? So fiscal policy has been accommodative as well. So for example, with lowering of interest rates, right? That has a broad ripple effect for the economy, right? So it affects, banks, it affects the real estate sector, it affects many sectors, right? What fiscal policy is doing though, is it's being more targeted, so to speak, right? So it's injecting capital or injecting cash in areas of the economy that really need it. So when we think about the hotels and the restaurants, when we think about persons that are below the safety net and need that additional source of income injected into their pockets because they've lost their jobs, that has been one of the major roles of fiscal policy, right? So it's really been very much accommodative throughout this period. I think the US has actually given stimulus in excess of about $4 trillion already, and they're tabling another 1.9 trillion right now to actually push more cash into the hands of everyday consumers, right? And the need for this is really because consumption, which Richard had mentioned before, is a driving force for the economy, right? So once persons have that lack of a job now, and that lack of income, then consumption declines. So something else has to come in and support that, right? And fiscal policy has really been that driving force.
And as I said, I have a burning question for you, Richardo. So we would have seen over the last year and a half, where the money supply in the US has increased tremendously. Some have even said that the money supply has increased to compensate some of the social programs and the social interventions that they're doing within the economy. Have we seen that much larger monetary base that would be chasing a relatively strict number of goods? Have we seen an increase in inflation in the US over the period, and why or why not?
Yeah, well, that's a good question. Simon, because certainly from the perspective of an asset manager, an asset allocator, the biggest question you can get correct right now is the direction of inflation, because inflation will impact on interest rates. So if inflation, for instance, overshoots significantly the 2% that the Fed is aiming at, then you're going to see some kind of upward movement in interest rates. If interest rates begin to increase, then you're going to see quite a bit of pressure, especially on equities that have enjoyed a significant run-up thus far, such as
probably partly on the back of the money supply increasing.
Right. And you could actually see maybe a sell-off in treasuries, etc. Right. So inflation, it is very, very important for us to get this correct.
Okay. So, Harton, and I mean, just to put the macro monetary and the fiscal into perspective, how has that affected fixed income yields? So Richard would have started to mention it, but walk me through how that has affected fixed income yields, maybe in advanced economies compared to emerging market or Latin economies, or Latin American economies.
So what's actually interesting is that in the 2020 period, we saw the highest level of issuances, meaning persons raising debt on both the investment grade, which we would consider to be the safer set of securities, versus high yield, which is considered to be more speculative or riskier. So what was interesting in that period is that persons would have utilized the debt market and the low interest rate environment, which we spoke about on numerous occasions. Those combination of things allowed persons to essentially raise large amounts of debt to gain cash, to essentially allow them to weather the storm. Now, it's different in the perspective of advanced and developed economies. Now, advanced economies, they have the fiscal capacity to support their economies. So the concern or the level of credit risk is different in an advanced economy versus where emerging market at the LATAM space would have mentioned, there's a different level of credit risk, especially in the perspective of Jamaica, for example, where it's tourist dependent, or a commodity exporting country like Trinidad and Tobago. Those things are going to have a spillover effect. So to the extent that there's a weakened demand on a global perspective, then naturally these are going to trickle over into impacting these economies, and then it's going to impact the bonds of these companies, of these sovereigns, and that is essentially how the fixed income market is kind of moving. So really and truly, the indicator I would say would be for the fixed income market on a global perspective is really going to be driven by the policy makers. And again, we have always emphasized that policy is really what's going to drive us right throughout this period. So the monetary policy in terms of the interest rate, the moment the monetary policy decide that they want to look any form of or the inform interest rate increases, fixed income is going to significantly pivot. People are going to pivot towards more fixed income securities, because why? Yields are going to start going up again, and then people are going to pivot out of equities, because now they can get that cash flow that they were looking for, or what that they're getting in the dividend yield and equities. They can start finding it back in the fixed income space. Then they start looking towards emerging markets again, and that is the kind of ripple effect it has. So everything again is really tied up back into the monetary policies on a global perspective.
And I mean, my statement on that would be there's another source of cash in the market that we don't often consider. We have large pension funds globally and insurance companies that still collect cash every month. Insurance somewhere, premiums. That cash, even locally, even if you look at the local context, that cash has to go somewhere every month.
Right.
No asset manager will keep all of that cash on their portfolio in fear of having a cash drag for that. So you have to put it somewhere. And if a company, an investment grade company, is issuing more debt, they may have the latitude to issue that debt in a crisis at a relatively cheaper rate.
Right.
Overall, and though the demand from this side of the market may drive down overall yields as well. So that's just another way that I was looking at it.